Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
This is going to be a fun episode, Eric.
Yeah, I've been wanting to do this one for a while.
And we had to jump through some hoops to make it happen. But it seems like a great moment to put the spotlight on the United States of America. We have President Trump back in the Oval Office. He has signed so many executive orders so far, but underlying it all is sort of like, this attempt to kind of reassert American dominance. When you think about the equity market in particular, USA is always number one, right, Eric?
Yeah. And, on our team, we have this persistent chat, and it's come down to basically like mocking Europe. It's like they're the, we just had the Super Bowl. It's like they're the Cleveland Browns, or they're just a bad team that just can never get going. And then the index that we specifically are just marvel at is the NASDAQ 100. We call it the eighth wonder of the world. It just keeps on freight training everything year in, year out. This is the Qs. And it kind of captures like that American innovation tech thing even better than the S&P 500. And so when you compare the Qs to like investing in Europe, it's just so night and day. But at some point, it's so much cheaper price to earnings ratio wise in Europe. Everybody's like, oh, it's got to go back, but it never goes back. It might go back for 2 months, but then people come right back to the Qs. And so I just think that the U.S. stock market, in particular the NASDAQ stocks and the Mag 7, are almost like abnormally, unusually great, where they deserve some kind of a scientific breakdown to analyze what's really behind all this, because it almost breaks your brain a little bit.
Well, you know who's not a scientist? Me or you. But it turns out we work with one. His name's Steve Hou. He's a quantitative researcher at Bloomberg. He has a PhD. You started talking to him a while ago about America and its greatness, right? What'd you learn?
Yeah, because, we were looking at tech and innovation in other countries, and it's just not, they have it there, but no one cares. Why is it rewarded in the U.S. and not in other countries? And we had an interesting conversation about the culture here, the regulations, the mindset, this sort of like, you can do it, and who cares if you fall on your butt? Like, that doesn't exist everywhere else. Like, a lot of people are just like, get in line and hammer. You know what I mean? Like, America is a special place, and we don't do everything great. We're not number one in a lot of things, Joel, but when it comes to like the stock market, man, we kick ass. The U.S. has 4% of the world's population, 20% of the world's GDP, and our stock market is 55% of the whole world, right? You got to go, I think number 2 is something like Japan, where Europe as a continent is like 8% or something like that.
So joining us on this episode, Steve Hou, quantitative researcher at Bloomberg Indices. This time on Trillions, Captain America. Steve, welcome to Trillions.
Thank you very much for having me finally. And Eric, yeah, good to see you.
So Steve, Bloomberg's a big place. I work in the news group. Eric works in Bloomberg Intelligence. What is Bloomberg Indices, and what's your day job?
So Bloomberg Indices is part of Bloomberg's data team now, and I am a quant researcher for Bloomberg Indices, and we create investable indices or portfolios which can be then licensed by asset managers and asset owners to track, right? We create investment products and indices that we license, and then once in a while, if we come up with something that we think is interesting, that's worth expanding a bit more on, and we write a long-form white paper.
Okay, so he's written some white papers. Did you read them?
Yeah, I mean, I skimmed them.
Okay, all right. we're gonna learn a little bit about
I sent you the pricing power white paper, which you said was very good.
Yeah, and the innovation. I mean, they're very good, and the index group is obviously mentally in the same ballpark as us because we write passive and ETF
but he
research.
sells stuff.
True. Yeah, you're on the revenue side of the building.
Yeah, and it's important. Yeah. There's a disclaimer there, which is, we're not going to talk
I'm on the cost side.
We're not going to talk our own business.
No. I'm part of the terminal value add.
So Steve, just big picture, what makes America fundamentally, with the research that you do, the data that you see, why is American innovation greater than anywhere else in the world?
So if you so we wrote this white paper because we created a index to try to capture innovation as a factor systematically, right? Out there's people talk about when you try to invest in innovation, how do you actually do it, right? There's the ARC ETF, which is an active ETF. Cathie Wood
made famous.
Selects them and it does what it does, right? And then there's the Qs, which is actually, when you think about it, not an intentionally innovation index. It's just as all the companies that happens to be listed on the Nasdaq exchange, which of course has agglomeration effect, right? Everybody sort of congregates that, but it's not intentional. So how do you actually do it? So we thought to actually look into some systematic accounting attributes. So R&D is a natural place to look, right? Companies spend and report R&D not always consistently, and they may sort of attribute things a little bit differently, but generally the direction is correct. And people previously have looked at R&D intensity, so normalized by sales, so they could compare companies in a cross section. That's one way to do it. But we found actually what's even better is actually to look at persistence of R&D spending. Right, companies that grow their R&D spending 3 consecutive years, year on year, right? So, and by screening for these such companies,
that gets expensive.
Yes, that gets expensive, but more than that, it also means that there's a high degree of persistence that needs to be funded by internally generated cash flow. On top of it, it probably is softly indicative of the skill set you have, the confidence in your own ability to convert, right, R&D activities, which is inherently very expensive and uncertain, into valuable intangible capital.
I want to go even deeper and just, I grew up in America.
Mm-hmm.
I basically was raised outside. I went down, played with people like Joel down the street. We got into football games in the backyard. Then I entered Little League games, had to get along with teammates from all over the place. There was also a feeling of optimism in my upbringing at all times, pretty much. It was like anything's possible. And then you go to high school and college and you're frequently grouped with people to work on tasks and as a team try new things. And I think
break down problems.
And there's also credit from being the one that does the good thing. Like there's a number one winner kind of celebrated here. Not to mention the bankruptcy laws and the regulatory environment. It just seems like I'm not sure how you replicate that.
I think recently there was a very good interview that Jeff Bezos gave at the Deal Book. He mentioned that one of the biggest, I think, reasons why America manages to have such a vibrant tech sector, innovative, industry, is because of the presence of a risk capital market, which is different from a banking market, right? Financial markets, if you think about lending, right? Banks lend. Europe has a very good, banking industry, but the ability to have risk capital, venture, right, to invest in things that has a 1 in 100 chance or even less to work out. That's gonna, when it pays out 1 to 100, 1 to 1,000. That is the type of risk taking that comes with, I think, both culturally and also path dependence, right? Some of it has to do with cultural, this idea of being encouraged as a child to try things and not be told that you likely will not succeed, but be told just try it, right? Then there is also the fact that America happen to have succeeded in the tech industry. A bunch of people succeeded by concentrated entrepreneurship and that equity appreciating, giving them the confidence of saying, yeah, I can take a risk investing in venture.
But if you take venture capitalists could invest in a European,
Mm-hmm.
they're not like just legally allowed to invest in the U.S. Like if they thought Europe was the better odds to get that like unicorn, they would go there, right? So like.
Well, part of it, I think, to be fair to Europe, is that Europe, when I recently I've taken a few business trips to Europe to try to understand how to actually get European clients to buy stocks. And one thing we've noticed that there's just such a huge amount of fragmentation of markets. It's impossible to get a huge market, right? Because every little country still has its own language, own regulation, and just customs. And it's impossible to scale a product. So if you're an Airbnb, right, you can have the entire U.S. market. If you succeed here, you become this behemoth, and then go overseas, everybody is lightweight. So I think it's a combination of issues. I think cultural, is certainly at the core of it, but there are other sort of institutional factors.
this idea of international also is something Bogle I wrote a piece about a month ago, and I was like, Bogle was kind of right about international. In '93 is the first time he had written, you don't really need international. The U.S. has all the capitalism you need. If you had followed his advice, man, you would have really benefited by not going international. So a lot of people that I know, advisors and portfolio managers, they're always in this dilemma of whether to rotate internationally, but it just doesn't ever pan out. And I think that's part of why this matters now, is that we got big valuations here, low valuations in Europe. But does Europe have to go up just because it's due?
Well, so the one thing is that if you recall about post-dot-com bubble in the early 2000s, that was a period when a bunch of sort of things that we are not used to did happen, right? International outperformed the US, right? Europe outperformed the US, EM outperformed the US, value outperformed growth, right? And bonds actually outperformed stocks, for many years. Until things sort of then resumed its long-run trajectory, and you had the triumph of the optimists. But there are conditions in which
I think the point you're making, though, which is a good one, Joel. Bogle really had very deep wisdom, and he knew U.S. would have bad years. He was going to stay invested. I think if you add international and bonds and this other stuff, when they go up and the U.S. goes down, it gives you comfort and it helps you hang in there.
Yeah.
So if you have if you're somebody who can't have the intestinal fortitude to just stick to the U.S. But the returns I'm talking about are actually inclusive of those bubbles bursting, 2008, 2001, international way lags. But you're right, there's these sections of time that could be years where you're going to underperform. But I think in Bogle's case, he was like, I'm committed to the S&P 500. I don't need the feeling that something else in my portfolio is up, which is a level of wisdom that's hard to get to.
Yeah, I mean, part of it is exactly because the U.S. is such a huge economy with such a tremendous complexity that there is everything that's happening, right? Instead of individual countries that's only exposed to oil or banking or so on and so forth. So this national boundary division was always arbitrary in the first place. I never really liked the comparison. People draw two lines of a U.S. outperforming Europe because it's not an apples-to-apples comparison. If you actually compared sort of sector weights adjusted or equity duration adjusted, you will find that the difference, while there is a premium difference, is not as big as one might have thought.
All right, Steve, I want to bring it back to your paper and how you think about building indices that can help capture investment, right? So you brought up persistent R&D being the data point that is kind of the North Star for this style of investing. How do you go about getting that data, by the way? It's all, the companies are doing this, but what do you see when you look at those numbers?
So companies, first of all, they are required to, sort of disclose their R&D and, spending expenditures. And, for a long time, depending on accounting treatment, if R&D spending is immediately, allowed to be expensed, they are actually incentivized, to expense it so that they can reduce their taxable, income. But more broadly, we are just looking for, in a systematic fashion, metrics that can most succinctly, sort of in a sufficient statistic way, identify companies accurately that fit the profile we're looking for. So in this case, we're looking for innovative companies. What is one metric that really captures companies' ability to innovate? And we zoomed in on the R&D spending metric. In particular, we found that more than the intensity is the persistence of R&D spending that really allows you to sort of screen down to the companies that are genuinely innovative.
What's an example of a company that goes big on R&D but maybe isn't as persistent? And what's that one that's more persistent? So
I don't want to go into an individual company, but more likely, I think is one thing is if you look at, for example, the ARK portfolio versus the sort of the Qs or in this case the Bloomberg BEvent Index, which
is something you created.
Yeah,
right?
Which we created and is comparable to the Qs. And here I want to give credit to my colleague Gaurav Panzi, who helped create this metric. Is that if you go back to compare the ARK ETF, membership, the companies in there spend a tremendous amount of money on R&D, right? And if you normalize by net sales, the average ratio is perhaps higher, in fact, than the companies that are contained in this portfolio. But if you compare the performance over time, sort of this index has tremendously outperformed the ARK portfolio over time. Now, why is that? It's because the companies held in the ARK portfolio tend not to be consistently profitable. As a result, they don't consistently spend on R&D. They sort of one of those things where they spend 1 year, when they have profits the next year, they spend less, and so on and so forth. So the average is high, but the persistence is not very high. And as we all know, so those of us who are trying to innovate, it's one of those things where you can't really you have to go get it, stick to it. You have to really, persevere through, and that's how you eventually make the discovery. And in fact, if you compare the U.S. Index and why it has outperformed Europe, going back to our discussion earlier, the biggest difference between U.S. and Europe is not even the level, right? It's actually the percentage of companies that have persistence, a high degree of persistence. And we started the millennium actually with the U.S. and Europe being at similar levels of intensity and percent of companies that have sort of 3 consecutive years R&D growth. And it was over the last 20 years that difference really diverged, right? And you can, so in the paper, you have these sort of tables, you can check out the numbers.
That's why, in my opinion, it's not just R&D spending, it's a U.S. thing. And I talk to people on Twitter a lot, and they say, well, you can get growth here. It's hard to get growth other places. Sometimes there's these speculative bubbles like in China, but pound for pound, you're just going to get more growth here in some of these big companies that are in the U.S. They're just growing.
But Steve's going to bring it back to persistent R&D being that thing. And if you go...
Yeah, but that exists in Europe too. But nobody cares.
Not like that.
Not to nearly the same extent, right? Over the last
you mean in percent increase?
That's right.
Okay.
The share of companies that sort of really remained persistent in R&D spending just dropped, right? And by sector, you can compare them. Whereas in the U.S. tech sector is sort of over 50%. In Europe you're talking about half that, and it peaked in 2013, and actually is even smaller today. In other words, I think it's a kind of in the American case, it's a kind of a virtuous cycle, right?
Yeah.
When you have these innovative companies, and I show in the paper that when they invest persistently in R&D, it produces intangible capital, which then becomes truly valuable, right? And it spits out cash flow, right? If Apple invents the iPhone, invents the AirPods, it becomes a successful product, and that cash flow funds the R&D, because R&D is inherently a very opaque, asymmetric information activity, right? You don't really want to raise external financing to fund it, because nobody's going to know how you're spending it. So you want to use internally generated cash flow, which is why what's nice about this metric we created is that we don't need to explicitly even screen for cash flow, because these companies that persistently invest in R&D automatically are profitable and generate cash flow, and they invest in themselves. So which is why today you are seeing the AI race is all the hyperscalers that are investing capex by the hundreds of billions themselves. They're not borrowing, right?
So what you're describing is effectively a flywheel, right? This
Yes.
is the R&D flywheel that's what makes America great.
Let's say we decided to go into Europe. Europe had a nice run for 6 months like 2 years ago. Is that flywheel going to start there and keep getting rewarded? In other words, are the European companies going to spend it as well or work as hard as in the U.S., where that R&D is rewarded with these intangible brands and huge great products that we have?
Yeah, I think that's probably a challenge. I mean, France, I think, just announced the 100 billion euro project to try to replicate or to emulate America's Stargate AI project. I think their challenge there is, I think, again, all these factors that are not pointing in the right direction, right? So they don't have a unified single market. The language is not English. It's hard for them to draw talent. They have a lot of sort of well-trained French engineers from the écoles, but it's hard for them to, I think, get to scale. You talk about the work culture. They don't have as much. I think the tax code probably makes it, such that people are not as incentivized to work those long hours, sleep on the factory floors and so on. I mean, I'm generalizing here. I mean, there are really genuinely creative, ingenious, hardworking people in Europe. Like there's the Mistral model, AI model, that's really, I think, state of the art. But I think if you're sort of, so to speak, generalizing, there is, I think, those factors that work against them.
Okay, so I used to take meetings a number of years ago with Huawei.
Mm-hmm.
Do you know what Huawei, the stat that they would point to? Persistent R&D.
Yeah.
And it was a big number. And they would like show it how much bigger they spent, how much more money they spent on R&D than American companies. So let's bring China into this. China spends a ton on R&D. What is that? How does that challenge your assumptions in your models?
So exactly, so this episode is Captain America, right? And the last 20 years, America is far and away the biggest, most successful, spender and creator of innovation.
By the way, Steve, you're Captain America. That was the joke.
Yeah, that was the nickname you got.
That's funny. Even though I'm not even
I know. It adds to the humor.
Just run with it.
So if you look in the paper, in figure 12, like I was sort of doing a tabulation of like what percentage of the companies, in various national stock markets that are persistent R&D spenders and what market share they take up in the overall stock market. America is, obviously number one, right, in terms of both counts. But number two is China, right? They started the decade negligibly low, right, close to zero. They started the millennium, right, in the early 2000s when China was much sort of further behind in terms of economic development, but they caught up in a very spectacular fashion. So if you look at the chart on, figure 12, that ascendant rise in R&D expenditures and the degree of persistence, almost catching up with America, sector by sector, right?
When we started talking about this, there was this great email exchange that led into an eventful weekend. I just want to look back on that for a second. The email that you sent was a couple weeks ago, January 24th. And you said there should be a fun one with all the hysteria about Chinese AI kneecapping American AI. And then on Monday, that was DeepSeek Monday, when everybody woke up and was like, what is DeepSeek? So you sent that email and I was like, it's great to have that time stamp because now we're going to go back and revisit it. How does your thesis hold up from before the DeepSeek Monday to the after DeepSeek wake?
So within the context of what we're talking about today, innovation, systematic, innovation factor, I think it actually ties in perfectly, and we'll see later why this entire phenomenon actually ties in very naturally to what we are talking about, the American culture of innovation. And to the extent we have this great geopolitical rivalry between U.S. and China, what people don't, I think, often fully appreciate in America is that China is really copies itself in America's mirror image, right? China, my generation represents a generation where we grew up looking up to America. When we first grew up, we used to think of the world as the West, right? The outside world, the abroad. And then we realized not all Western countries are born equal, right? There is Europe, which is the old world, and then there's America, in particular the Silicon Valley. And gradually, we have had millions of Chinese students coming over to study in America. They acquired that American sort of can-do spirit, the entrepreneurship, the ability to reinvent the wheel and not be afraid, not be laughed in your face. And that's why Shenzhen is China's Silicon Valley. And that's why you are increasingly seeing sort of Chinese innovation success, which we'll talk about how China sort of succeeded sort of by copying America, not just, in terms of literally the blueprints, but also more importantly in a cultural sense. And that's the reason why I think China has actually, it's one of those things where you can't really catch up overnight, right? You have to sort of practice and practice and practice, just like with any sport, right? For you to get onto the game, actually shoot with a high degree of percentage, So I think that's what we are looking at. So America still has the tremendous lead, but China presents a formidable challenge.
So let's bring it back to AI specifically. U.S. has obviously been at the lead of this. The DeepSeek moment sort of suddenly suggests maybe there's different ways to go about making better AI models. How does that sit with your research?
So to the extent that, so my research is about identifying, innovative companies, and we indeed actually sort of find the same sort of companies that are succeeding in AI in America through our index, and people can look at sort of the membership. And we have also applied the same methodology to China, identified, sort of similarly creative and innovative companies in China that are doing well. With respect to DeepSeek, I think it's actually a very good illustration that innovation is one of those things where you're sort of paddling upstream, right? You are always sort of persevering, and so you can make progress, and otherwise you'd be caught up. The DeepSeek moment is really nothing special other than the fact that we are continuing along the scaling law, right? Sort of costs of compute has always gotten cheaper. When you guys were first entering, the workforce, and computers were much slower, right? Today, computers are tiny, and on the phone are much faster. And then there's nothing special about it other than the fact that it happens to have come from China. And further innovation will take place in America. What DeepSeek has done was not even necessarily novel in the sense of they invented brand new techniques. Those techniques had actually been already published by Google, right, a year and a half ago. Google didn't manage to actually make it sort of commercially work as well as DeepSeek did. But generally, the idea is that one thing we've learned, hardware advantage is one thing, but, human capital is still ultimately the most valuable.
At the beginning, I mentioned that the U.S. stock market is 55% of the global market cap. Do you see that, growing to 60, 70? I mean, given how small we make up 4% of the population, that is a big disparity, obviously. Where do you see that number going? Do you see the money consistently rewarding the U.S. like the flywheel? Or do you think that the valuations will just get too wide and you just have to go to Europe for just because it's cheap?
Well, I think of it one of two ways. Fundamentally, I don't think it's an accident, right? Stock market is not magic, right? America, I think, even though has such a tiny population, is one of the world's unique immigration country, right? The immigration system is a funnel. The H-1B system, which was much talked about a few weeks ago, essentially is a funnel for the world's sort of finest talents, right? So even though, the population is very big, you manage to attract the world's brightest, most best educated population that have been educated by other countries' expense, right? So whilst that doesn't change, I see America having a structural advantage. Now, will that change? We don't know, right? There seem to be some political winds shifting. And with respect to whether or not we can have a stock market bubble crash, that's always possible. But it is what happens afterwards. Will America continue to have that structural advantage with respect to the rest of the world? That remains to be seen over the next few years.
Steve Hou, this has been fascinating. Thanks so much for joining us on Trillions.
Thank you very much for having me.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.